So we'll start with VRM1, measures of financial risk today. Okay. Now, first, let's start by discussing the kind of risk measures, okay, that we have to deal with. So we all are aware of standard deviation, right? Standard deviation is the most basic risk measure that we have studied till now. In fact, it was introduced in quants, and later on, when the chapter FRM 5, Foundations of Risk Management, chapter number 5, we discussed it in great detail. Okay, that what constitutes total risk and what constitutes systematic risk and all those things. So standard deviation was a measure of dispersion or a measure of total risk of the portfolio. Okay, then we have VAR. Okay, so standard deviation we all know. Okay, that it is a measure of dispersion. Okay, and VAR, and I'll also tell you expected shortfall together. So VAR and expected shortfall, they basically focus on the extreme part of the outcome. So what can go wrong and how much can go wrong? Okay, if situations are really adverse in the markets, those things are captured by VAR and expected shortfall. Okay, now VAR is widely used in practice. Okay, but expected shortfall, although the prevalence of expected shortfall, in fact, under the latest regulations that are coming up, we're going to see that expected shortfall is going to be used more and more, and it has been prescribed at a higher level by the regulators also now. Okay, very soon those regulations will also be implemented. So, expected shortfall actually has more desirable theoretical properties. Okay, and it is also an example of coherent risk measure, which we'll see later on. We'll define what is a coherent risk measures, and there are certain desirable properties of these coherent risk measures also, which we'll discuss. Okay, so let's start with the mean variance framework. Now, the mean variance framework, if you remember, has been introduced in, again, it's the same chapter number 5 of Foundations of Risk Management, the capital asset pricing model, okay, and modern portfolio theory. So it is based on the mean variance framework only. Okay, we all know that there is a trade-off between risk and return. Okay, the greater the risks are taken, the greater the expected return that can be achieved. Okay, now again, see, there is one confusion which should not remain in your mind, is that what is the meaning of this word expected return? Expected return does not mean that the return which is expected to occur. Okay, basically, in pure statistical terms, it means that you want to describe the average mean, average return or a mean return. Okay, that is the whole idea behind expected return. But yeah, it is kind of a proxy for the return which is expected to occur. Now, one of the measure of risks is the standard deviation of returns. Now, tell me one thing, for any asset which is risk free. I mean, for example, let's take practically the closest to the risk free asset, which are, say, treasury bills. Okay. So, what will be the standard deviation of those assets? Correct. It will be zero. Absolutely correct. Zero standard deviation. Okay. So, any risk free asset will have a zero standard deviation. Now, let's discuss combining investments. In fact, this part used to be a precursor of the fifth chapter of Foundations of Risk Management. Before modern portfolio theory, we actually studied this formula of expected return and variance of a two asset portfolio. Okay. But now it directly we have the after 2020, we have MPT and CAPM introduced in that chapter before having the efficient frontier and all those ideas and two asset portfolios, which have been discussed in that chapter to some extent. But this formula was not there. In fact, this formula was introduced in one of the quant chapters. And when you see it, you will recall it. It was introduced in one of the quant chapters only. So let's say we have two assets, asset one and asset two, and their mean returns are given to be mu1 and mu2. Their standard deviations are given to be sigma 1 and sigma 2. So in your portfolio, you have only two assets. Okay. So if the weight of asset one in your portfolio is W1, and obviously because the sum of weights must be equal to 100%, the weight of the asset two in your portfolio will be 1 minus W1. Okay. So if you want to find out the expected return on the portfolio in total, then it is simply the weighted average of the expected return from the two investments, because it's a very simple formula. For standard deviation, we have a little more complicated formula, just a little more, which again we have seen in one of the quant chapters. Basically, it also takes into account the correlation between the returns of the two assets. Okay, so this is the formula for standard deviation, and these two formulas you have to remember by heart. In fact, it's not very difficult. If you see, this is something like the formula of a plus b whole square, this entire term with an extra term of correlation with the pairwise terms. Okay. So anyways, you'll remember it quite easily. W1 square sigma 1 square plus W2 square sigma 2 square plus 2 times W1 W2 sigma 1 sigma 2 multiplied by correlation between assets, the return of assets 1 and 2. So this term inside the square root is the variance. So obviously, if you take the square root, you get the standard deviation of the portfolio. And simple questions based on this can be asked in the exam. Okay. Next, if suppose we have more than one asset instead of, sorry, more than two assets. Okay. Instead of just two asset portfolio, if we have more than two assets, then the same result can be extended to more than two assets as well. So we have a portfolio of n assets. So you can see clearly that this summation is nothing but W1 mu1 plus W2 mu2 plus W3 mu3 and so on. So basically, the mean return is again replicated in the similar way, the weighted average of all the returns. And for the standard deviation or variance part, this is the expression. Actually, again, I'll say we don't need to get too much bothered by the structure of the expression, because finally it will result in the same thing over here. Okay, for two asset portfolio, this is the idea. Okay, so basically what you're doing, I'll just explain what is exactly happening. See, you are pairing all the assets with each other and also themselves. For example, see, I also starts from 1, J also starts from 1. So when both are equal to 1, when I is also equal to 1, J is also equal to 1, what will be the correlation between the asset 1 and its own return? Obviously 1. The correlation with any asset with respect to itself is 1 only. And this will become W1 times W1, which is W1 square. This will become sigma 1 square. Similarly, we have another term W2 square sigma 2 square. Okay. And then, of course, when the correlations are different, we have row 1 to W1 W2 sigma 1 sigma 2, and it will be twice, because once it will be row 1 2, then you will have row 2 1. Okay, because it is double counting is being done over here. That is why you have a 2 over here. So obviously, if you have a 3 asset portfolio, it will become W1 square sigma 1 square plus W2 square sigma 2 square plus W3 square sigma 3 square plus 2 times this term, then again plus 2 times, there will be another similar correlation term between 2 and 3, W2, W3, sigma 2, sigma 3, like that. And another term between 1 and 3. So everything, all the possible combinations have to be taken care of and included in the standard deviation term. That's it. Okay. Now, what is the efficient frontier? This also you have seen. What is the efficient frontier? Now, before that, if you remember, there was actually a universe of assets, and universe of portfolios where all possible portfolios were mapped actually. So when all possible combinations of all risky investments are considered, the efficient frontier of all risky investments is obtained. Okay. And then if you have a risk-free asset, if it is combined with the market portfolio on the old efficient frontier, you get a new efficient frontier line, which is tangent to the old efficient frontier curve at point M. Okay. I hope everyone remembers this, because we have studied these things in great detail in Foundations of Risk Management, chapter number 5. And then if you change the weights of the risk-free asset and the market portfolio, any return can be obtained on the new efficient frontier line. Now, for those of you who are not able to recall, this was the diagram. I hope now you recall it, right? So this is the new efficient frontier. This was the old efficient frontier. This is the tangent line. This is the market portfolio, right? Now tell me one thing. There was something called as risk-free borrowing also. I mean, we assumed risk-free borrowing also in that model. So what was the implication of risk-free borrowing? Anyone who can tell me? If suppose you are allowed to borrow unlimited at the risk-free rate, then the implication is that you can obtain points on the line FM, it means the new efficient frontier, which are to the right side of M, which are beyond M, right? Okay. So again, we can see the same idea like this. For example, if you consider this point, central point, it will be like 50% in the risk-free asset and 50% in the market portfolio, right? Okay. But if you want to have portfolios beyond M, then obviously the weight in the market portfolio will be 100% at this point. Okay. At 0% weight will be in the risk-free portfolio at this point. What about after M? You'll have to increase the weight in the market portfolio because you're going beyond M. Okay. So weight in the market portfolio will actually become greater than 100%, which implies weight in the risk-free asset will be what? Negative or positive? Correct. So in this zone, if you remember, in this zone, the weight of the risk-free asset was negative and the weight of the market portfolio is actually more than 100%. So this idea is very, very important. This whole idea is extremely important. Okay, so that you understand the idea very, very carefully. Again, same thing we'll carry forward from the foundations of risk management chapter. Okay, now this is also something which we have dealt with a lot in the normal distribution. Okay, and actually it plays a central role in VAR calculations because it's the most commonly assumed distribution, I should say, for for many applications, including VAR calculations. Lucky, which part was not clear? Have you attended the class of Foundations of Risk Management, chapter number 5? Modern portfolio theory and CAPM. So we did detailed examples. Don't remember? We started from this point, then we went to this point, 2575. Then we went to this point, and then after that we took examples where we had 125 or 140% in the market portfolio and negative 40% in the risk-free asset. That part you remember now? So it's the same thing that we are discussing. Nothing new actually. Do you remember now? Okay, so nothing new. Don't worry about that. Exact same thing which was discussed in that chapter is just being repeated over here. Okay, just to uh, have some more clarity and a little bit of revision. That's it. Okay, since it's a part of this chapter, you can treat this part as just a revision of that section. So, as I said, normal distribution is a convenient choice in finance. Okay, very, very convenient to assume that returns are normally distributed. And then the calculations and the results that we get are actually easy to obtain. But the problem is that in practice, financial variables tend to have much fatter tails than the normal distribution. Okay, this can be illustrated using data on the S&P 500 index. So I'll just show you the data that has been given. See, this is the result which is predicted by the normal distribution. Okay, yes, absolutely, Vedant. Financial returns are actually left. In fact, that was going to be my next question when I went to the next slide. But anyways, great that you remember it. Okay, so they are financial variables are generally having a leptokurtic kind of distribution. Okay, so predicted by normal distribution. See, normal distribution predicts that 31.73% of the outcomes, okay, or approximately 32%, will be beyond one standard deviation away from the mean. Now, if you remember, 68% value, you remember the first value that we actually discussed when we studied the normal distribution and confidence interval was actually 68%, right? Because 68% of the observations were within one standard deviation of the mean. So the same thing again I'm saying is being repeated, correct, within one sigma. So if this is 68%, right? If this is 68% approximately 68%. So obviously, if you subtract 68% from 100%, what are you left with? You're left with 32%. So that's why you can see this is actually very close to 30. So 32% of the observations are beyond one standard deviation away from the mean, predicted by normal distribution. But actually, it is less. Okay. Because this is not the tail actually. One standard deviation is not very far. Now, as you move further and further into the tail, normal distribution predicts 4.55% beyond two standard deviations. But in reality, we have a little higher, 5.01%. Now, as you move a little more, towards the extreme value, beyond three standard deviations, normal distribution will only tell that 0.27% of the observations should lie beyond this point. But in reality, what has been observed, okay, and this is not only true about this S&P 500, it is true about almost all the financial variables, most of them, okay, most of the major indices, even stock price, stock returns. So you'll see that you have higher percentage of results as compared to what normal distribution was predicted. And in fact, beyond four standard deviations, the probability gets very, very small based on the normal distribution. But see, in reality, there are, and this is very close to zero. Obviously, normal distribution cannot predict zero anywhere. So 0.00000 something, right? But for real world, you can see there have been events. In fact, if you observe this possibility, 0.12%, 0.12% means maybe, I mean, see, 0.1% means once in 1,000 days, right? So even returns greater than six standard deviations may have been observed once in 1,000 days. That is also possible. Okay. Or if it's, let's say, if we are talking about, say, annual return, then of course this is a projection that once in 1,000 years this can happen. Okay. So this is the whole idea that the financial variables in practice tend to have much, much fatter tails as compared to the normal distribution. Okay. So you can see over here, the actual distribution is this, which is clearly more peaked also and has fatter tails also. You can see that this solid line is higher in the center also and is higher on the extremes also. So absolutely, Vedant, these are leptokurtic distributions. Okay. So as far as standard deviation is concerned, we have given the same standard deviation to both the distributions. In fact, mean is also very, very close, almost same. But you see, the actual distribution is more peaked as well as tails are fatter. So it's a leptokurtic distribution, which means that both very small changes, I mean, around the center, because these represent very small changes, right? If you are tracing this from here to here, very small changes. Okay. So even for small changes, they are higher in number. Okay. So for small changes also, in reality, they are higher in reality. Okay. As compared to normal. And even extreme large changes, they are also higher. So if you go to these areas, so extreme large changes, they are also higher. Okay. So this is the idea. Now let's introduce VAR, which is an integral part of the FRM Part 1 as well as FRM Part 2 curriculum. And in fact, I think if you relate FRM Part 2 with FRM Part 1, you'll find that many topics, in fact, 60% of the topics will be new. I mean, you haven't done any kind of foundational studies in part one, even for those 60% topics of part two. So it's completely new. Operational risk, credit risk, liquidity risk, a lot of new things are there. At least 60, I'm saying. In fact, it can be more than that. Uh, but one concept which is integrated in FRM part two also, which I'll say carries forward from part one, is actually VAR. And in two of the modules in part one, which is market risk and investment management. You have VAR being discussed a lot. So that is why we strongly recommend in the part 2 study plan that we go, even if we go module by module, first we should cover market risk, then we should cover investment management, and then the other books, even though investment management is the second last book, okay, before current issues. So because VAR is discussed in both the modules, right? How is this tested in the exam, especially in combining investments? The same numericals which are there in the videos, Lucky. Okay, same numericals. You can just go through them in the videos, in the questions. I mean, it is being tested exactly in that way. Okay, and of course the concept. You have to understand the concept also. That the return was the weighted average return, and what was the formula for standard deviation. That's it. I think if this is tested two asset portfolio, most probably it will be about the formula only. Okay. Okay. Now, as I said, VAR is tested very, very heavily integrated into both the curriculums, part one as well as part two. Now, let's discuss some practical examples using Excel, because in the video we have done all the calculations manually. So in the class, we'll show you how to use Excel, how to create your Excel files, so that you can understand the combining investment parts also, how to calculate standard deviation also, and we'll discuss some interesting ideas as well. Okay. So let me know if it's visible or not. I'll just share the screen first. Okay. And in fact, Lucky, you'll get a practical example also of how combining investment will be tested in the exam. Okay. So this is the Excel. Has everyone watched the pre-class video? Okay. Because all the numericals and everything we have done manually. That's why it's very important. See, we can do the same thing in the class also. No problem at all. It will take probably the similar amount of time in the class also, doing the same thing. But if you want an extra perspective, that's why we use Excel sometimes in the class to make sure that you understand the implementation part in Excel also. Okay, so if you have not watched it, you are actually missing out on how to do those things, manually, which is also very, very important from the exam point of view. So that's why combination, we always say it is very, very important to go through the pre-class recording and then attend the class after that. Okay, so first let's see how to calculate standard deviation. Now, this is the classic standard deviation formula actually, which we have used over here. And I'll also tell you that if we use the embedded Excel formula for standard deviation, what kind of results we can expect. Okay, so standard deviation, I'll just write the formula for you guys. If you remember standard deviation, okay, say for any return, okay, or a series of returns or any variable for that matter, it can be x also, is equal to square root of expected value of r square minus expected value of r whole square. Do you remember this formula? Expected value of x square minus expected value of x whole square. Do you remember this formula from quants, from many, many chapters? In fact, we have not only discussed this formula in a single chapter, many chapters there were there in quant. Yeah. So yes, it's the square root of variance basically. This was the way of finding variance. And mind you, we are not talking about combining investment right now. We are talking about a single variable r or x. Okay. So this is for a univariate case. Okay. Even though it's not a part of this chapter, but it's better to just recall those formulas. Okay. In fact, I'm not saying that they may not ask the standard deviation formula directly from this chapter. In fact, it doesn't matter actually. Even if they ask the calculation of standard deviation, they'll give you a table with probabilities and they'll ask you to calculate the standard deviation. So it doesn't matter which chapter, because it's a part of three chapters, three chapters. It can be from QTA 3 also, it can be from VRM 1 also. So the idea will be same. Now, what was the idea behind finding expected value of r square? Expected value of r is simple. right? We just find out PIRI, this part, okay? And then we add PIRI completely, right? But of course, for expected value of R square, which again we have done in detail in quants, manually also, in the class also, as well as the main videos also, we actually square the returns and then multiply them by the probabilities. Okay. So you can see over here, we are actually doing PI, probability multiplied by return square. So one of the formulas I'll show you, you will be able to relate it. So you can see that this is return square. First we have calculated return square and then we have multiplied it by probability to get probability multiplied by return square. So this is something which we do continuously. Now if you add this, you will get expected value of R square. This sum of all these values, okay, this sum of all these values, just a minute, of all these values, okay, is actually this one. Okay, so it is nothing but the expected value of R square, the first term. And this is the expected value of R, okay, PIRI summation. So obviously, what will be the formula for standard deviation? Expected value of R square. You can see clearly expected value of R square, which is 65.577 minus expected value of R, which is 5.4205 whole square. Okay, so you do 65.577 minus 5.42025 whole square and then you take a square root of that. So what will you get? 6.01647. Very, very simple basic calculation in Excel. Okay, so these probabilities will be given to you. Okay, and then you will have the returns. You will have the returns and the probabilities. This will be given to you. Okay, and then you have to just carry out the basic calculations. Nothing more than that. Now tell me one thing. I mean, I'll just show you something interesting. Let's say instead of calculating this manually, even using Excel, we have done in a manual kind of way, right? We have not used any embedded Excel formula. You know that there's a standard deviation formula in Excel, right? This one. And we are considering that it is a population. So we multiplied all the probabilities by all the returns. So obviously we are considering it to be a population. So if we use the standard deviation of population direct formula and apply on these returns F5 to F19, why am I getting a different answer? Okay. I mean, and remember, this will change every time I go for the calculation because some macro content has been enabled and external links have been enabled so that the data can be fetched automatically. That's it. But that's not your problem. You don't have to worry about that. Suppose you have this. Okay, you get the standard deviation as 6.27. Can you tell me why we are getting standard deviation of population as very different number? No, actually, Vedant, as I told you that even in the top part, we are considering it to be a population. So we are not saying sample standard deviation. No. If suppose there was any case of sample standard deviation, then maybe we could have said that, it is because of the n and n minus 1 difference. See, because of the n and n minus 1 difference, this will happen. I'll tell you. Even if you want to check, okay, so I'll just write it over here. This is for the population. Okay. And then very good, Ujjwal. Absolutely correct. Spot on. Anyways, I'll answer to that one also first. So, and if it is the sample, then if it is the sample, then I can just use is equal to STD. I'll use the sample standard deviation. Okay, so and then I'll take all the returns. Okay. Okay. So this is for the sample, 8.15. So this is the reason of the difference between n. So over here we have taken n, over here we have taken n minus 1. Okay. But why the difference of the calculated standard deviation from the embedded formulas values? Absolutely. Very good. Because Ujjwal, we are considering probabilities. Now this formula as well as the BA2 plus calculator formula. Both of them are valid if the returns are equally weighted. So in the exam, if probabilities are not given, if the returns are equally weighted, you just have to, do nothing. You don't even do manual calculation. You open your data and stat buttons, which we have shown in the calculator videos. Just plug in the numbers, get the standard deviation. Finished. I mean, hardly you'll take, I'll say 1 minute for this entire thing if you use the calculator, not even 1 minute. But because they are probability weighted returns, that is why we are getting a different result for standard deviation manual calculation by using probability. But these two formulas, this one and this one, they assume that the probability for all the returns is same, equal. Understood? So how many observations are there in total? In total, how many observations are there? In total, 15 observations are there, right? So basically it considers that the probability of each observation is 1 by 15. These two formulae. Okay, this one and this one. Clear, Vedant? The idea? Why it is different? Okay, so this is a very important aspect that you need to understand. Also, see, the data, the probabilities you see every time they are being populated, we have used some functions. Every time they are populated to make sure that the sum of probabilities is always equal to 1. Okay, and that's why I said it's not your problem right now. You forget about it. You just focus on what exactly is the application part from the formula. Okay, now let's come to combining investment. So this was for a single investment standard deviation. Now let's come to combining investments. Okay, so we have two assets where the returns are given for both the assets, asset A and asset B. You have a return as 24%, asset B return is 21%. Volatility of asset A is 30%, volatility of asset B is 25%. Correlation between A and B is 30%. Okay. So all these things are given. Now what we do, we actually start with a weight of 0 and in A and with a weight of 1 in B. And then we change the weight of A every time step. We actually increase it by 5% and decrease this by 5% so that the total is always 1. You can see this point over here, this point is actually having a return of 21%. So actually it's the first one. So if the weight of asset A is 0 and if the weight of asset B is 1, so obviously you'll get 100% of the return of B only, which is 21%. So we are at this point, this last point. Okay, this one you can see clearly that this is the series. Okay, so yeah, this is the last point where the volatility is 0.25 and return is 0.21. You can see it's clearly mentioned that because volatility of asset B is 0.25 and return is 0.21. Okay, 100% weight is in B. Now, as you increase the value of the weight of A, something very interesting happens. And this is a practical demonstration. In fact, although we are using only two assets in the efficient frontier theory, we actually had all possible combination of assets, right? So even if we assume that those all possible combinations are only, can only be derived by using two assets only, because there over there assets were also multiple. Even if we do that, we get the same efficient frontier shape over here. You can see that. So this is a very nice and practical example of why the efficient frontier is shaped like this. Okay. So this is nothing but the calculation of returns. We have just used the weighted average formula. You can see over here W1 or WA mu A plus WB mu B. And this is a simple formula for the variance. You can see that square root of W1 square sigma 1 square W2 square sigma 2 square plus 2 times W1 W2 sigma 1 sigma 2 and multiplied by the correlation. Okay. So this is the idea. Is the idea clear? What are we doing? And this is the plot. So which part is your efficient frontier? Which part is your efficient frontier? And which part is your minimum variance portfolio? You remember there was something called as minimum variance portfolio. So it will be somewhere around here, right? This is your minimum variance portfolio. And above the minimum variance portfolio, this part is actually your efficient frontier. So Lucky, is it clear what kind of example, what kind of questions can be asked basically? Okay, you'll be able to calculate only one cell basically in the exam. If it is asked, only one of the cells you have to calculate, nothing more than that. So they'll give you the weight like this. Let's say they'll tell you 20% in asset A, 80% in asset B. And then this is the correlation is given. You have to find out the expected return and expected volatility. That's it, finished. Okay, so this is the efficient frontier. Now, can you tell me why this was not efficient? These portfolios are not efficient. We have done these things. Why the bottom part is not efficient? Anyone who would like to pitch? Yes, very, very good. Excellent answer, Lucky. For same level of risk, we are seeing less returns. Absolutely. Yes, correct. Other portfolios are giving more returns for the same risk. So this is not optimal. These are suboptimal portfolios. These are optimal and efficient portfolios. Very good. Then if we scroll down, you can see just for illustration, we have also given the comparison of the two asset with another three asset portfolio. So in this, basically the first two assets are same. Okay, we have added another asset, asset C, and we have given these pairwise correlation so that we can get the return and volatility. You can see obviously there will be much more points over here, many more points because there are we are combining all we are or you'll say we are getting all possible combinations for a three asset portfolio, which will obviously be much higher than all possible combinations of a two asset portfolio. But the efficient frontier is still the same, this part. Okay, this is your efficient frontier. Yes, absolutely. The weight will be like this, Ujjwal. But yeah, the same thing we have done. We have actually started with, say, yeah, actually, the calculation will be like that only. You just have to ensure that, to start with, of course, A plus B plus C is 100%, which, of course, this expression which you have given A by A plus B plus C automatically ensures that the sum of weights is equal to 100. But we don't start with actually that point. Okay. So we have assigned some random weights. Okay. And we have ensured just again some external links and some macros have been used just to ensure that at every single row, if you see the sum, you'll see it is 1. You can check every single time. So all the possible combinations we have seen. Okay. Not all I'll say because in fact there can be even infinite possible combinations, but more or less we have seen almost everything. Okay. At least in terms of structure, you can see so many observations were required. You see over here. Okay. And these are proxy numbers which we are not showing you actually. With these, we have changed the font to white over here. Okay. So this is the idea. You can see that so many points had to be taken to show the total possible combinations. Even in this case, you could have made it more granular. Instead of increasing the weight by 5%, Ujjwal, you could have increased the weight by 1% over here. So obviously you'll get more points. So that's the idea. Okay. Now let us come back to VAR. Let's start VAR. Now, what is VAR? VAR is an extremely important risk measure. Very, very important till now at least. It focuses on adverse events and their probability. Okay. So it is a function for any investment opportunity. It is a function of two parameters. You have the first parameter being the time horizon, and the second parameter is the confidence level. So what is the definition? Definition is something like this. It is the loss that is not expected to be exceeded over the time horizon at the specified confidence level. Okay, so we'll just give a small example over here, but we need to understand that regulators have historically used VAR to determine the capital that banks must keep when internal models are used. Okay, so let's take an example. If you want to understand this definition, those of you who are uh, actually seeing it for the first time, yes, absolutely, Vedant. It is used in regulatory capital as well as economic capital calculations. Now, VAR is the loss that is not expected to be exceeded over the time horizon at the specified confidence interval. What does this actually mean? Suppose this is given 10-day 99% VAR is equal to $12 million. So what it means that 99% of the time your 10-day loss will not exceed $12 million dollars, or your loss over a period of 10 days will not exceed $12 million dollars. That is the meaning and definition of VAR. And of course, if 99% of the time the loss is not exceeding 12 million, then you can rephrase the same idea in an opposite way. using the significance level actually, although you'll not say the word, but you can say that 1% of the time the loss will exceed $12 million. So both are giving you the same picture, just in a different language. Okay, I can say both are two sides of the same coin. Okay, although you have to make some distinctions when especially you use discrete distributions, which side you have to consider, because the middle point always becomes a problem. The middle point is the point which will divide the 19, not the middle point, the boundary point, which will divide the 99% region and 1% region. For continuous, it is quite okay because the probability at a single point is always zero. So for continuous, you just draw a line. One side is 1%, the other side is 99%. But what about discrete distributions? We'll see those examples also. So if suppose this has to be illustrated diagrammatically in a continuous distribution to understand it more clearly. Okay. Now again, the safest distribution that we can assume is the normal distribution, although practically it is not accurate, but the safest distribution we can use is the normal distribution. So if we assume that the returns are normally distributed, then this is the visual representation of this statement, that you have a loss of $12 million, which we have written negative 12 million because this is a return distribution. So loss means negative returns. That's why we have written negative 12 million. So in a return distribution, 1% of the time only, the returns will be to the left of negative 12 or minus 12. Okay. And 99% of the time, they will be towards the right of negative 12. Okay. Or minus 12. So that's the whole idea behind VR. So is it clear to everyone? What is the visual interpretation over here? Is it clear? The visual interpretation is clear to everyone? Okay, great. Now, time horizon is very, very important because see, a 1 day time horizon and a 10-day time horizon and a 1 year time horizon are going to be very different. Now, I'll tell you, the practical relevance also of time horizon. See, uh, you can have VAR not only for market risk, but you can also have it for credit risk, right? So even for credit risk, if you have a lot of derivative transactions with some counterparties, if your institution, let's say, is having many derivative transactions with the counterparties, of course, there's credit risk, there's default risk, downgrade risk, what a lot of things are there. Because of that, the the portfolio of the institution might reduce in value. The other entity, the other counterparty may default, or in fact, even if the risk of default increases, the value of the portfolio might decrease. So generally, let's say if you're talking about credit risk, Vedant, I'm answering your question from the perspective of application directly. Okay. So if suppose you are dealing with credit risk, will the company be concerned that the counterparty will bankrupt in 1 day only? Think about it. Practically, when we talk about credit risk and a large position has been opened with any counterparty, what will be the concern? What will be the concern in terms of time period in general? It will be like a exactly very good for probability of default and particularly for credit risk calculations. In fact, when you study part two, you'll find that credit risk VAR is actually based on a 1 year time horizon. Okay. And market risk VAR can be based on even a 1 day, 10 day, okay, time horizon, 1 day or 10 day time horizon. Because credit events are not going to happen every single day, right? Next day only the counterparty will not default, or there will not be a risk of default. Over a longer period of time, there will be a risk of default. And the longer that time duration is, the riskier the things become. So a standardized practice, Vedant, is to take 1 year for credit risk VAR. And this is where this time horizon comes into picture. Okay, the answer to your question. But for market risk events, where market variables are fluctuating every single day, a 10-day window seems quite reasonable. Even a 1 day window for trading activities with that. There are two kinds of book. We have the banking book, we have the trading book, and even for say, even for a normal retail trader, forget banks right now. What will be the time horizon that the trader is interested in? 1 day, right? So over there, 1 day VAR will be very, very important. Okay. So that is the idea behind time horizon. Great. Okay. So next, continue. Yes, absolutely lucky. 10 days means 10 consecutive days. Absolutely. Okay, obviously you will have non-working days will be excluded because that is why we consider 252 trading days or 250 trading days in a year, right? Because Saturdays, Sundays, and holidays are off, right? So apart from that, okay, it will be consecutive. You can omit those holidays on Saturdays, Sundays in between, and then it will be consecutive. Okay, so if you start from tomorrow, your 10 consecutive days will be how much? From tomorrow till the next Friday. Got it, Lucky? That's the idea. Okay. Fine. Now, let's continue. The common probability distribution of losses arising from assets, either you can have a normal distribution, again, not very practical. Uniform distribution, again, not very practical, but this is just a common probability distribution of losses that we are going to consider. Then you can have a discrete distribution also. So again, all the calculations we'll see using Excel for normal as well as uniform as well as discrete. Now, if you apply a little bit of logic in uniform, I mean, it's going to be very, very easy, right? I have showed you in the common univariate chapter, uh, chapter number 3, actually, that, instead of going with the formula of uniform, it's always better to remember that finally it forms a rectangle and you use a little bit of geometry. The things that we have done, right? Area of rectangle and all those things. So it makes your job easier. But of course, the choice is yours. If you want, you can remember the formula and then you can solve the questions. No problem. Now, more sophisticated models are required to calculate VAR when the probability distribution of losses are non-normal. So for normal, we are going to see and the calculations in Excel. So first, before we go to the Excel, let's introduce expected shortfall also. Now, expected shortfall is the expected loss after the VAR threshold has been breached. It is calculated as the probability weighted average of tail losses after the corresponding VAR level. Now, this, as I told you, has more desirable properties and is coherent risk measure. But apart from the theoretical properties, desirable theoretical properties, this is actually more useful. Most of the practitioners are now agreeing that this is actually a much more useful measure because the problem with VAR, see, VAR tells you that at a particular specified confidence level, how bad, what is the possibility that you can have, okay, that this is your uh, threshold level. So it tells you the threshold level beyond which the chances of losses are quite less, only 1%, say, or 5% for that matter. But it does not tell you that if things become bad, if things become bad, how bad they can become. Okay, so once the losses exceed the VAR level, VAR will not tell you anything about how bad those losses can become. Maybe the VAR is $12 million, but let's say the VAR is breached and it is breached very, very heavily, and the loss is, say, $40 million. VAR says nothing about that. Okay, so this question is actually answered by expected shortfall. Okay, expected shortfall tells you that if the threshold has been breached, if things have become bad, then how extremely bad they can become after that as well. Okay, so that is the difference. So the one way of calculating it is simply the probability weighted average of all the tail losses after the corresponding VAR level. So again, we can take an example, the same example over here. So VAR is this boundary region. Okay, you can see this VAR is this boundary region. Exactly. But extent of losses or the average loss that you can expect once this boundary has been breached is this, the weighted average of this region. So basically the probability weighted average, the weighted average of this black region is your expected shortfall. Okay, so VR is just a boundary And then this is the weighted average. I think Vedant also had a question, if I'm not wrong. Uh, Question, yeah. The question is that how do firms decide at what value they need to set? Yes, this is a very good question. See, most of the things have to be standardized because see, Vedant, if suppose there are two big banks, then if one of the banks is setting the VAR say at a 95% level, the other is setting at a 99% level, then obviously there is a lot of disparity, right? So these things are generally decided at the regulator levels, and the banks have to simply follow that. So you'll find that when we go to the subsequent chapters, you'll find that for regulators, the confidence level which they prefer, for certain types of risk is actually 99.9%. So once in 1,000 days or once in 1,000 years kind of events can also be tracked. Particularly in fact, for credit risk, there are very strict norms regarding 99.9%. Okay. For back testing VR, the norms are a little different. Okay. So obviously there'll be some difference in what kind of we are measuring, but mainly they will be governed by the regulations at that particular time. And of course, there can be regulations which are evolving, and maybe the confidence level, if at all the regulators decide to change it, obviously the banks will have some time to adopt those kind of changes. So the time horizon is also something which the regulators kind of specify, and it is standardized in the market as well. Okay, for internal purposes, internal calculations, there can be some kind of flexibility, but even then, I mean, the time horizon and confidence levels are actually standardized to a large extent. Okay, yes, economic capital is not governed by regulations, but still, Vedant, that's why I was saying even for internal calculations, which is actually mainly related to economic capital because that's mainly internal in nature. Even there, they try to follow that level of standardization, Vedant. Okay, as much as possible because it makes sense, right? Yes, boards too. Absolutely. Okay, so now let us see the formula for expected shortfall for a normally distributed variable. Again, I think from the exam point of view, this formula is not important. Okay, we have given it uh, because it was asked in one of the sample paper questions. So we've given it, but I personally don't think that they'll test the expected shortfall of a normal distribution at a particular confidence level. I don't think they will. But anyways, once you solve questions, I think this formula can be internalized also, no problem at all. But even if you miss it, don't worry too much about it. Of course, if we are very, very unlucky, then I cannot do anything. But again, I'm telling this in probability terms. I mean, there's a very high probability that this formula will not be asked in the exam. Okay, now let's come to coherent risk measure. Now, before we come to coherent risk measures, we can go to Excel after this only because I think this is the last slide. So let's discuss it and then straight away we can move to Excel and we can end the session. So a coherent risk measures satisfies four key properties. Okay. Now these key properties are quite important, quite essential for understanding the financial risk or assessing the financial risk in a very, very consistent and you can say very rational manner. Okay, so what are those properties? We have monotonicity. Okay, monotonicity. It means that if y is more risky than x, then the risk measure corresponding to y should be greater than the risk measure corresponding to x. So simply, basically, it is about intuition. This property of being monotonous in terms of the coherent risk measure is just about plain intuition and consistency, I'll say. See what this does. This simply exactly correct, Vedant. This is something like a rank ordering because this ensures that more risky assets are assigned a higher risk measure. Okay, and this is intuitive, right? Quite intuitive. Then we have another property called as translation invariance. Now it says that if suppose you add a risk-free amount of say cash, K is cash, just for the simplest of cases, the most risk-free thing you have is cash. Although even practically sometimes this also is not true. Sometimes. I'm not talking about inflation and all those things, okay? So because that will come into a completely different kind of discussion, okay? So I'm not talking about that. Okay, so if you add a certain amount of cash to a portfolio X, then the total risk of the portfolio should be reduced by the same amount, exactly by that amount. Okay, so again, this I'll say, although mathematically also very, very close, but see, the calculations are not generally additive in nature because you have to respect the formula for risk over there. Risk is you don't calculate standard deviation like this, right? Simple addition of two variables, right? Obviously, you have square and then correlation and all those things. So those things will be considered. But after considering that, you will find that the risk of this particular portfolio with X and cash will be less by an amount of this K, that certain cash amount, with respect to the portfolio X. Okay. So again, very, very predictable and intuitive that if you're holding extra cash, you are kind of reducing the risk in a predictable way. That's it. Okay. Then you have the third property, which is homogeneity. Okay. Now this has something to do with scaling actually. If you scale the portfolio by a factor of lambda, the risk will also scale by the same factor. Okay, so basic again, let's go into the intuitive understanding. So let's take just a hypothetical. Let's say if you're doubling your portfolio, so your risk also doubles. That's it, finish. Okay, and if you're reducing the exposure, your risk will also reduce proportionally. If you're reducing the exposure to say 60% of the current exposure, the risk will also reduce to 60% of the current risk. That's it. Then finally, you have sub-additivity. So sub-additivity tells you that the total risk of two combined portfolios or two combined assets is less than or equal to the sum of their individual risks. And you know what is something which is very, very closely linked to the property of subadditivity, which we have done in modern portfolio theory and capital asset pricing model? Diversification. So basically the idea is if you combine two portfolios, okay, then diversification will reduce the risk. Okay, or at least if the correlation is zero, let's say if there is no diversification achieved even by combining, then at least it will not increase the risk. So equal to sign is also there, less than or equal to. So this sub-additivity property is a very, very desirable property for real world risk management. And this is where VAR falls short. VAR is actually obeying the first three properties, but not sub-additivity. Okay, we have shown some examples also, particularly in part two. We have very detailed example. In fact, in part one also, if you see the video, we have shown the example. Very layman kind of example is also given and a very technical example is also given. Okay, so these properties are very, very important because whatever risk measure you are using, I mean, if it's coherent and it follows these properties, of course, if it's coherent, it will ensure that this risk measure that you are using, it behaves in a very logical way, a very consistent way, intuitive way, practically useful way in financial markets. Okay, so this is the idea. Fine. So that's it for this lecture. We'll just go to the Excel and we'll see the calculations and then we can conclude this particular chapter. So let's go back to the Excel and let's see the VAR for a normal distribution. Okay. So let's say you have a portfolio value of this much. Okay, it's $1 million, basically 1, 2, 3, 4, 5. I think it's $10 million actually. Yeah. So Lucky is saying that his understanding is for translation invariance by paying more DP as a down payment in absolutely not for you, but for the bank. Yes, 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 absolutely. I think it's a very good example actually. If you see, but again, it's from the perspective of the bank, right? Not from your perspective, because your risk is not getting reduced, Lucky, right? Your risk is different. In fact, bank is having risk that you will not pay, right? Collateral and all those things is okay. Homogeneity is not clear. Okay. So homogeneity, it simply meant that if suppose, I mean, it's just a proportional reduction and proportional increase thing. Suppose, Lucky, for example, let's take your case only. Okay. You bought, say, a Tata Indigo. Okay. And you took a loan of, say, 6 lakhs. Okay. Then, uh, if suppose at the last moment you decide that no, I don't want an Indigo, I want to say Nexon. Okay. Tata Nexon. And then for that, you have to take a 12 lakh rupees loan. Then for the bank's perspective, okay, from the bank's perspective, your loan portfolio, I mean, of course, bank will have a lot of other loans also in their portfolio, but just a simple example, based on your portfolio, the risk of the bank has actually doubled, right? Because when you were taking 6 lakh rupees loan, there was a certain amount of risk for the bank, and now the risk is double because now you have taken 12 lakh rupees for the Nexon. Is it clear now, Lucky? Homogeneity part? I'm just using same context from your example. So for translation invariance, the bank's risk is reduced if you pay more down, if you are making more down payment and taking lesser amount of loan. But for homogeneity, you have to increase, you're increasing the amount of loan only. Yes, yes. Homogeneity, Vedant is saying n 5 comma 5 multiplied by 10 is equal to 5. Absolutely. Absolutely. But the problem is, see, n you are saying is normal distribution. See, normal distribution in itself is not a measure of risk. The expression is completely, absolutely correct, Vedant. But instead of n, we should use this something else, which is obeying this property, some other risk measure. Normal distribution is a distribution, right? It is not a risk measure. Sigma, or say expected shortfall, ES. Got it? So you can say ES 5 multiplied by 10, a 5 star 10 is equal to 5 times ES 10. Got it, Vedant? That makes more sense. Okay. So yeah, wonderful discussion, good examples from all of you. Let's go back to our Excel and what were we discussing? So yeah, this is the portfolio value. Okay. This is $10 million of portfolios there in terms of dollars. This is the annual return 10%, standard deviation 15%. So if we have to calculate, so we have taken two confidence levels over here, 95% and 99%. Okay. And we have also shown what is the difference between percentage VAR and dollar VAR. So percentage VAR, if we have calculated, we have simply done it like this. What is this expression doing? This expression takes a normal distribution with D5 and D6 as their mean and standard deviation. D5 and D6 means 10% and 15% respectively. And then it calculates the fifth percentile from the left side, of course. Okay, because it's a profit or the return distribution. So fifth percentile from the left side. Okay, and if you see the point, it makes sense because the fifth percentile from the left side will be this point, this particular point. Okay, you can see it gets highlighted over. If you click on this, this is the point. Okay, the fifth percentile from the left side or the boundary, you can say the 95% tile boundary, this boundary. This is your 95% VAR. Okay, this is your 95% VAR. And obviously, if you take 1%, this uh, the boundary from the left side in the first percentile, this one, this is your 99% VAR. That's it. Okay, this is what we have taken over here. You can see that we have taken 1% over here. Okay, now just be careful about one thing that sometimes, and in fact, not only Gar, but many authors have done this. They generally interchangeably use 95% VR and 5% VR. So when they are talking about 95% VR, it means that they are referring to confidence level, 95% confidence level VR. And when they are talking about 5% VR, then that 5% is significance level. So that also means that it is 95% confidence level VR. because 5% significance level is 95% confidence. So generally, most of the cases you will find it's 95% is only written or 99%. But just in case if they write 5% VAR, then don't assume that it is 5% confidence. No, because it doesn't make any sense at all practically. Okay, the confidence level should be greater than 95 or at least 90%. 95 is always better, 90 greater than 95%. Okay, so this is the usage. Now, for calculating dollar VR, you simply multiply the percentage VR by the portfolio value finished. That's it. Because if in in percentage, if it is negative 0.1467280.4, okay, which is negative 14%. So if the total value of the portfolio was $10 million, so 14% of that is $1,467,000. Okay, no problem. Now Ujjwal has given a value of negative 1.645 over here. Okay, now can you tell me when this negative 1.645 is relevant? Can you tell me? When we are talking about what kind of distribution? When we are talking about a standard normal distribution with a mean of 0 and variance of 1. So 1.645 is absolutely perfect number. But is this distribution having a mean return of 0 and standard deviation of 1? No. So that is why it will be exactly not negative 1.645. Okay. Fine. But still, if you have to do the theoretical calculations, this in the exam, this number is still important because in the exam we won't have Excel. And that is what we have done in the main video. We have shown each of these calculations using the manual method. So that also we'll do right now. So as we discussed that, the left side of a standard normal distribution is actually negative 1.645. But even if it is not a standard normal distribution, we can still use the 1.645 idea of a standard normal distribution, because even if it is mu, this mu, which in this case is 10%. Okay, so basically we have to traverse a distance of 1.645 standard deviations from the mean, correct? Right, Ujjwal? This is what we have to do to find out the VR value, right? So even though standard deviation is not one, but finally the distance, irrespective of the mean and standard deviation of the distribution, if you remember the the observations that we had on both sides, yes, exactly, perfect. We were having beyond 1.645 standard deviations, we were having actually 5% on the left hand side and 5% on the right hand side. Correct. So this is mu minus 1.645 sigma, and this is mu plus 1.645 sigma. So in the exam, you simply have to do absolutely correct. You have to simply do mu minus 1.4645 sigma. So let's do that also. 10% minus 1.645 multiplied by sigma, which is 0.15. Can you do this calculation and quickly tell me what are you getting? Can you quickly do this calculation and tell me what are you getting? And do it to 4 5 decimal places. I would please recommend that, just so that we can compare our results to the data sheet, the data given in the cell D12. D12 we'll compare it with. Check it properly. 23% or 14%? Yes, correct. 14.6. Very good. So all of you are getting negative 0.14675. Exactly this number, correct? Yes or no? Okay. So negatives, if you approximate it, it's also the same thing. Negative 0.1467, right? Okay, and for 28, they've approximated it to 50. That's it. So that's why we have a 5. Finished. So is the idea clear behind VR? That once you understand the concept of the normal distribution, VR is actually nothing new if the distribution is normal. You don't have to remember any new formula. The logic will be consistent, the same logic that we did in quants. So is the idea clear to everyone? Okay, great. Now, just one twist that we can have in the exam questions, that instead of the return distribution, and of course, to calculate 99% VR, which critical value you will use instead of 1.645? For 99%, which critical value you will use? 2.33, correct, 2.328. Absolutely. Just try and recall this. Lucky not 1.96 is wrong because to the left and right of 1.96, you have 2.5% of the observations, right? So total was 5% on together on both sides. So that will give you 97.5% VR actually, Lucky. So if you use 1.96, Lucky, critical value, I'm just mapping it for you guys. So if you use the critical value as 1.96, you'll get the VAR confidence level as 97.5%. Okay, Lucky. Okay. So see, we are interested in case of VAR. In case of VAR, we are always interested in the one-tailed critical value. Always, because VAR, we are only mapping one of the tails, not both tails. Okay. So only the one-tailed critical value. That's why this 1.645. This is also a one-tailed critical value at 95%, if you remember. So what is the one-tailed critical value at 99%? 2.33. Correct. Okay. So got it. So 2.328 or 2.33 something or whatever you want to approximate it to. It's 2.33 basically. We can use 2.33 safely in the exam. Okay. Now, as I said, that one twist that can happen in the exam, that instead of the profit distribution or return distribution, they will give you the loss distribution. So everything will be same actually. The logic and all these things will be same. Only the distribution will flip, and instead of subtracting, you'll have to add. You'll have to actually have to go to the right of the distribution. Okay. So if you have a loss distribution, the same thing if it is framed in the form of a loss distribution. So obviously, if VR is a loss, you have to go on the front side, not the back side, or the right tail, not the left tail. So just remember that part. Okay. And again, how will you calculate it? See, if the mean return is 0.1%, a mean return of 0.1% means what? It means a loss of negative 0.1%. Correct. So if the profit distribution is having a mean of 0.1, then the loss distribution will have a mean of negative 10%. This is a loss distribution. Okay. So you will have a mean of negative 10%, and you have to go on this side. So basically what we are doing, we are adding, we are going to the right hand side. We are actually adding. So you do one thing, you do negative 0.1 plus 1.645 multiplied by, again, the standard deviation, which is 0.15. So obviously you'll get how much? You'll get 0.14, the positive number basically. Now you'll get, you can see that. So you'll get a positive number because now it's a loss. So positive loss completely okay, no problem. So both calculations, again, I'll use the same terminology. They are two sides of the same coin. The only thing is that distribution has been flipped. So just take care. What are they giving you in the exam? Okay. Although you can play it very, very safe, irrespective of whatever they give you, you convert it into a profit distribution only. You work with this because your job will be, I mean, easier. It will be consistent for you. But you are free to use your own logic, completely your choice. Now let's come to the uniform distribution. This is very, very simple. Very, very simple. So if suppose you have, uh, and you remember this is the PDF. If you remember, we had the PDF, we had the CDF. In fact, this is actually the CDF, not the PDF, I should say. So again, just like normal distribution, when you use the Z table or when you use the norm.inv function, basically we are dealing with the CDF only, right? So we're here also we are dealing with the CDF only. So this is how you can calculate the VAR directly, okay, based on that percentile. So you can see that this is how it has been calculated. Okay, the same formula has been used. B minus A multiplied by 0.01 for 99% VR, because 0.01 is 1% plus A. That gives you X. So this is straight away the formula for CDF for a uniform distribution. Based on that, you get the value. But again, I'll say, I mean, if we just want to use a little bit of common sense, a little bit of math, geometry, we can do it quite easily. See, what is the total range? Minimum value is how much? Let me just increase the size so that it becomes more visible to you. So minimum value is how much? Negative 20. Left side is negative 20. This extreme point is negative 20. And this is 30. So what is the total range of this distribution? Total range 50. Very good. So you have to find a point which divides this range into two parts. 1% on the left and 99% on the right. So what is 1% of 50, guys? What is 1% of 50? 0.5, correct. So basically you have to take 0.5 on this side and the remaining 49.5 on the right hand side. So basically you find a boundary to the left of which you have 0.5 area length, and to the right of which you have the remaining length. So obviously if this length is 0.5 only, so obviously this value will be nothing but negative 20 plus 0.5, which is negative 19.5. That is your VAR. So which method is simpler for you in the exam? Do you want to use the CDF or the simple plane geometry? Or unitary method, you can say 1% of this 50. What will you prefer? Again, I'm saying you're free to use the formula completely. Yeah. Whichever you feel is comfortable for you, do that. And again, the same twist, if this changes to a loss distribution, then you'll have to go on the right hand side. That's it, nothing else. It will be given. Lucky, it will be given to you. Okay, it will be given in the exam. Otherwise, how will you solve it? So it will be given that some variable is having a uniform distribution with the extreme values as a equal to this much and b equal to this much, or starting point and ending point as this much, or it is between this much. They can give something like this also, uniformly distributed between these two ranges, as like this, negative 20, comma 30. So you have to understand that we are talking about these extreme points. Got it, Lucky? It will be given in the exam. Now let's come to a discrete distribution. Now, in this case, I'll be very cautious in this chapter because I'm going to explain the details of discrete distribution in the next two chapters, actually, one of the chapters today. That's why I'll be very cautious over here. I'll just give you a very simple idea about discrete distribution. So these are the outcomes which have been sorted in a ascending manner if you consider returns, and descending manner if you consider losses, because if these are outcomes, then negative 10 means a loss of 10. But if these were losses, I would have to change it to 10, 4.4, like that. But these are returns or outcomes, and these are sorted returns. You can see they are arranged, sorted. These are the probability values of these returns. Okay, now for discrete distribution, what we do, we tend to find out the cumulative probability, okay, every single time we encounter a new outcome. So let's say we have an outcome of negative 10. This negative 10 has a cumulative probability from left side as 2%. 2%. Then what is the next outcome? Negative 4.4. The second worst loss is 4.4, or negative 4.4 profit. Now this is having a cumulative probability of 0.06. Okay. So once we have breached the 5% level, you are already in the zone of 95% VAR. So try and understand this. This is 2% and this is 6%. Where is 5%? 5% is somewhere between this, right? Actually, interpolation would have been better, but as of now, GARP prefers it to be a bit simpler. So rather than having the interpolation Vedan, in fact, in part two, I've discussed this to be, interpolation to be used heavily. In fact, earlier, I'm telling you, when we had the hybrid approach, which they have removed now, in hybrid approach, I've shown, in fact, in the videos, if you see, I've shown the interpolation process in detail, which is not in this chapter actually. I think it's the third chapter. So, but that is not a part of the course now. Okay. And the interpolation also we have done very beautifully using geometry of straight lines. Okay. In the book earlier before 2020, when this was actually in the course, interpolation, they used to have the formulas over there. But again, I always suggest that when geometry works for you, formula is not required. So you can go through the video to find that example. But again, if you're not very interested right now and you want to save your time, you can watch it after the exam because interpolation is now not in the syllabus. What they prefer in this version of the curriculum is that suppose if we are at 5%, I mean, if we are at 6%, and if we want to know where is the 5%. So instead of interpolating, you simply assume that once you have crossed 2% and once you have reached 5%, so whatever data point is after that, immediately after that, which is negative 4.4. So your VAR level will be same as negative 4.4 basically. That's the idea. Ideally, it should have been interpolation. Okay. So basically the weight of the next observation carries forward completely and this 5% VAR simply becomes, or 95% VAR I should say, simply becomes 4.4. That's the idea. Okay. Similarly, 99% VAR will be this only because you have reached 1% is over here. This is 1% or 99% VAR, but there's no value over here. So you look for the next value basically. Okay, guys, please understand this. When we are talking about discrete distributions and when we reach a certain cumulative frequency corresponding to that VAR level, for example, for 95% VAR, we reach at 5% cumulative frequency or cumulative probability. We find that there is no corresponding value over here. So we look for the next value after that. Understood? That is how you have to calculate the VAR for discrete distributions if probabilities are given separately. Is it clear? Is it clear to you? To all of you? Only the next one. Again, I am repeating. You reach 2%, you have to calculate the 95% VR, which means you have to reach the 5% cumulative probability level. Okay. 5% from the left side. The same thing that we were doing in continuous also. We were reaching the 5% or 1% mark from the left side. So once you reach 5%, you find that there is nothing because the next mark is 6% cumulative probability. So there's nothing at 5%. So you see what is the next possible one? The next is 6%. Corresponding to that, you have the VAR as 4.4. That's it. Yes. Not negative 4.4 Vedant, 4.4 because this is outcome. It means these are returns. Return is negative 4.4 means loss is 4.4. So although you'll say that yes, VAR is 4.4, but automatically it will imply that it is a negative 4.4 loss. Okay. So at outcome negative 2, we reach 0, 0.4. What are you writing, Lucky? I'm not able to understand. Where is 0.44? I cannot find 0.44 anywhere. I cannot find negative 2 also anywhere. I think you've fumbled the decimal places. Can you just check once again? Just write it once again. I'll reply to your query. Yeah, cumulative probability, which one? Outcome negative 2. Where is negative 2 outcome? I cannot see. Ah, 2 outcome. Got it. This outcome, right? Yes, yes, yes. At outcome 2, you have reached a cumulative probability of 0.44. Correct. 44%. So if someone asks you, you know, what is the 56% VAR? You will say -2 because it's a profit of 2, right? At 56, since the cumulative probability, I'm just giving you a hypothetical case, although it will never be asked. At 44% cumulative probability, you reach where, Lucky? You reach at +2, correct? +2, correct? So +2 means a profit, not a loss, correct? So in terms of loss, how will you represent it? You will say -2 because VAR is always expressed as a loss, not as a profit. That is why. Okay. And this 44% cumulative probability translates to 56% VAR, confidence level VAR, right? So the 56% confidence level VAR is actually -2 because it's a profit of 2. So it means it is a loss of -2. It means, in fact, there is going to be no loss. That is the expectation. That 56% of the time, you'll always be in a profit. That is the expectation of at least $2. If it's in hundreds of dollars or thousands of dollars, then $2,000, $2 million, whatever, based on the units. So that is the idea. I think it's a good thing actually that we discuss this 44% part also, because see, practically it will never be asked. No, no chance. But you get an idea that, even at low confidence levels like 56%, I mean, you can say something at least. You can express something. And 56% of the time, which is not a very high confidence level, you don't expect to lose. Okay, Lucky. In fact, you expect to gain. So is it clear? So I'll say that 56% VAR is actually -2 because of a 2 profit. Yeah. So for yes, suppose we have to find out 50%. Since there is no entry, Lucky, corresponding to 50%, we will see the next number. What is the next number after 50%, Lucky? What cumulative frequency we have? Cumulative probability? 61%. Very good. So it will be 4.7. Finished. So 50% of the time, your loss will not be greater than -4.7. Or for that matter, 50% of the time, your profits will be at least 4.7. That's the idea. Very good. Actually, we had this discussion. Okay. Fine. So that's it for this particular lecture. So I'm going to end this right now. Any particular doubts in this chapter only? In this chapter only. Okay. So we are going to end the section, this chapter. Yes, in the lecture, in the main lecture, right? Yes, we will see based on the time path. First, let's complete VRM 1, 2, 3. The plan is yes. The plan is to go for it today only, QTA 12. I don't want to delay it at all. Okay, so yeah, we will go for it today. No, mics are not muted. You can unmute yourself. No problem at all. Please go ahead. Everyone is, I think you can unmute your mics, right? Right? Nitin just unmuted. Lucky just unmuted. Everyone is able to unmute. You want to speak? Wait, let me just see if I can. No, yeah, I'm getting an option for asking you to unmute. So I've asked you to unmute, but I'm not able to unmute you, Parth. Can you speak now? There's a problem with the audio line. You are unmuted, but there's a problem with your audio line actually. Yes, Lucky, you were saying something that in this lecture we discussed about the new efficient frontier. Correct, correct. The same new efficient frontier that we had discussed in detail in the modern portfolio theory. Yes. So, any doubts related to that? Shall I go to that slide? I'll just share the PPT once again and I'll go back to that slide, the new efficient frontier. Please tell me what is your doubt in that. Yeah, new efficient frontier. Correct. But where there is some lower part also, yeah, because that is not efficient. That's why we have not written. Actually, you will have a lower part. Yes, you will have a lower part. It is not efficient. This part. Yes, you will have it. Not only below M, you should say below A, because below M, there is anyways, there is a part, it's shown. But below A, which is the minimum variance portfolio, the part has not been shown because it is not efficient, Lucky, because we answered right. Not this in the tangent line. Okay. This one, this part, that we have also discussed. There's a point, hypothetical point we discussed. Maybe this point is having 50% in risk-free asset and 50% in market portfolio. Maybe this point is having 25% in market and 75% in risk-free asset. Like that. Same thing we discussed in the modern portfolio theory, right? In detail. That's why we have not discussed in detail in today's class. It's relatively safer. You should not say it's safe. Again, it's all about the degree of risk that you are taking by traversing this line from left to right, or I should say from southwest to northeast. The more you go towards the southwest, the less risky it is becoming. Okay. And the more you go towards the northeast, the more risky it is becoming. At the extreme point, this RF, it becomes a virtually risk-free portfolio, not practically, because again, even T-bills, they might be a proxy for a risk-free asset, but still they have, because of course they are backed by the full faith of the US government, but still theoretically they have risk. So theoretically they cannot be considered as a risk-free asset, but yeah, practically yes, they are the safest investment. This part will be safest. And as you move towards the northeast, you are taking more and more risk and more and more risk. And at this level, you are taking the same risk as the market. And then as you move even further, you are taking even more risk than the market. That's it. Got it? Okay, fine. So that's it then. Let's end the lecture. Yeah, lastly, please go ahead. Please go ahead. Okay, again, I said that we will discuss only for this particular chapter. I will definitely give my opinion on new GST. In fact, I was planning to write something, but anyways, see, the only thing that I can say right now is that from our perspective, since there was no benefit at all from to the educational institutions, private educational institutions, so students, our students are not very happy, I'll say. I mean, they would have been in a better place if this 18% could have been probably reduced to 12 or 5. So for the fees and all, you would have to pay less GST. So that would be better, I'd say. And it would benefit us also, because revenues also, of course, go up when the GST amount is low. Students actually tend to enroll a little on the, I'll say the enrollments would have been little on the higher side. So yeah, at that level, from a company standpoint, it's not beneficial for us. But I think overall, I think I'm very positive about it. Overall, it's actually a good exercise, I'll say, definitely. And considering the things that happened recently, and the geopolitical events, I should say, I think to counter those also, and of course some domestic policies also, and I think this change was long warranted. I mean, this was required actually. Let's see the execution, because see, the problem is that the planning has always been really good in the past, also in the last 10 years, 11 years, a lot of good planning and sometimes excellent execution has also been done. But for many good planned schemes and good planned ideas, good policies, the execution has not been that kind of, the top-notch execution that we probably were expecting. But ठीक है, it happens. Of course, it is not even possible sometimes, right? Execution is hard. Planning is sometimes easier. Execution is actually the hard part. And it only does not depend on one institution or one entity or only at the government level. A lot of things are there when it comes to executing things on the ground. So yeah, we'll have a discussion. If you want, we can have a separate discussion. Okay, not today. Okay, when we get time, because today we are quite heavy on the chapters. Today, you all know we have 4 chapters, and I'm targeting all those 4 chapters. I don't want to delay. So QTA 12 also I'm targeting. Parth was asking that question. So that will be the target. So that's why we'll not have it today, but definitely we'll try to find some time. And let's say what we can do. Let's inch closer to the exams, because the implementation is going to come during Diwali, right? So I think after that we can have the discussion. No problem at all. Okay. Fine. Thank you very much, everyone. So we'll just end this session right now, and thank you. I'll just let you know the time for the next class right now itself. I'll just stop the recording and I'll write the time for the next class. Thank you. Within a few minutes only, we'll join. Yeah. Thank you.